Have you ever woken up, grabbed your phone, and felt your heart sink when you see the market numbers flashing red? Picture this. It's April 15th, 2025. You check the S&P 500, down nearly 19% year-to-date. You glance at the Nasdaq, off almost 24%. Your morning coffee goes cold in your hand and a pit opens in your stomach. Meanwhile, in Omaha, Nebraska, Warren Buffett is leaning back in his chair, unshaken. Same headlines, same chaos, but he's calmly sipping iced tea on his porch, watching the world panic. Why? Because since early 2024, he has been quietly selling stocks and stacking cash. By December, Berkshire Hathaway's cash and equivalents had swelled to $334.2 billion, around 28% of its total assets, the highest in the company's history. Think about that for a moment. While countless investors chase the next hot tech story, Buffett was preparing for the inevitable storm. He's done it before. Remember 1998 when the internet bubble was about to burst? He held cash then. Remember 2008 before the global financial meltdown? He held cash then. And remember March 2020 when the world froze and markets plunged? He held cash then. Each time when fear reached its peak, he pulled the trigger, buying great businesses at fire sale prices. Today feels eerily similar. Corporate debt levels are near record highs. Interest rates have climbed from 0 to over 5%. Geopolitical tensions are simmering in multiple hotspots. Credit spreads are widening, yet headlines still trumpet "buy the dip" as if nothing has changed. What is Buffett seeing that we're not? What silent alarms are blinking on his dashboard? More importantly, how can you, without a $300 billion war chest, build your own safety net so you never have to watch your portfolio evaporate? How can you transform panic into opportunity rather than panic into regret? Over the next 30 minutes, we're going to strip away the noise, tear through the hype, and uncover 3 simple but powerful ideas you can start using today. You'll learn how to look past daily price swings and focus on the real engine of value, cash flow 10 years from now. You'll discover why giving yourself a built-in cushion before you buy can protect you when markets swing wildly. And you'll see how holding a modest reserve of dry powder, cash or near cash, lets you move instantly when bargains finally emerge. This isn't about predicting the exact bottom. It's not about timing the next Fed announcement or guessing which sector will roar next. It's about preparation, discipline, and a handful of habits that have allowed one of the greatest investors ever to surf every crash without getting wiped out. You'll hear real stories. How Buffett watched dot-com mania peak and then snapped up household names. How he sidestepped the 2008 credit implosion and then wrote multi-billion-dollar checks into blue-chip banks. How he skipped headline airline bailouts in 2020 and quietly bought gold and secured liquidity lines at rock-bottom levels. Each episode offers a blueprint you can follow step by step. By the end of this session, you'll have a clear, actionable framework. No jargon, no buzzwords, just straightforward steps you can apply whether you manage $10,000 or $1 million. You'll know how to define what really matters, how to protect yourself from downside, and how to seize upside when opportunity finally knocks. So take a deep breath, set aside the fear, and let's get started. You're about to learn how to build your own crisis cushion, so when the next storm hits, you'll be ready. Let's start by shifting your focus from stock prices to cash flows. Picture 2 gasoline stations. One sits on a sleepy side street, old pumps, few customers. The other guards the only highway off-ramp for miles. Its convenience store buzzes 24 hours a day. Both report $5 million in revenue, but their futures couldn't be more different. When you look at cash flow, you're asking, how much money will this business generate 5, 10, even 20 years from now? Here's a simple way to get a rough estimate. Pull the last 3 to 5 years of free cash flow from the company's annual reports, average those numbers, and then discount that average by about 10% per year for 5 years. After year 5, assume a conservative 2% growth in perpetuity, add up those discounted cash flows, Divide by the number of shares outstanding, and you've got a per-share intrinsic value. If the market price sits at least 20 to 30% below that figure, you've likely uncovered an opportunity. You don't need a PhD to do this, just a spreadsheet, a handful of numbers, and the discipline to trust the process. Over time, this practice trains you to see through hype and zero in on businesses that can weather storms because their cash engines keep running. Once you've done this exercise a few times, you'll start spotting differences between frothy valuations driven by headlines and real durable value driven by cash. And that insight will form the backbone of every buy decision you make moving forward. Another key habit is sticking to your circle of competence, investing only in businesses you truly understand. You don't need to be an expert in every sector. Instead, pick 3 to 5 industries where you can read annual reports, follow industry trends, and confidently explain how the company makes money. For example, if you work in tech, you might know SaaS business models inside out. You understand recurring revenue, churn rates, and customer lifetime value. Focus your analysis there. If you're a consumer goods buyer, you might know which brands command premium pricing and why. That deep familiarity makes your cash flow estimates more reliable and helps you spot shifts before the broader market does. Limiting yourself to a tight circle not only accelerates your learning curve, but also prevents mistakes born of false confidence. Owning 5 companies you can explain over coffee beets. Owning 50 you barely understand. As you define your circle, keep a running watch list of potential buys, businesses that meet your valuation and margin of safety criteria. When prices dip to your targets, you'll already have your short list ready, and you won't waste time scrambling to research in the heat of a sell-off. Once you know what a business is really worth, you need to give yourself room for error. Imagine you calculate that intrinsic value at $50 per share. Rather than buying at $49 or $48, set your buy target around $35 to $40, 20 to 30% below your estimate. That gap is your margin of safety. Why does this matter? Forecasting cash flows isn't an exact science. You could underestimate costs, overestimate growth, or miss a macro shock. By insisting on a meaningful discount, you build a buffer against those errors. When everyone else is panicking and dumping at a 30% loss, you're stepping in at a 20% discount, so even if the company underperforms, your downside is limited. In practice, use limit orders at your target prices. If shares never dip that low, you keep your cash and move on. If they do, your order executes automatically. No midnight screen checks, no emotional second-guessing. Over time, this disciplined approach keeps you from overpaying and protects your capital when the unexpected hits. Now let's talk about keeping dry powder, cash you can deploy the instant opportunity appears. A simple rule is to earmark 5 to 10% of your portfolio in ultra-liquid assets, money market funds, very short-term treasury ETFs, or a high-yield savings account that stays ahead of inflation. When valuations stretch, say average PEs climb above long-term norms, you might top that cushion up toward 15%. That way you're not chasing overheated prices, and you have firepower on hand when markets wobble. When one of your target stocks dips into that 20 to 30% discount zone you calculated, you pull cash off the sidelines and buy immediately. Automate the process by placing limit orders at your pre-agreed entry points. No late-night screen checks, no gut-wrenching second guesses. If the price hits your level, your order executes. If not, you simply keep waiting. Over time, this turns knee-jerk reactions into calm, calculated moves and puts you in Buffett's shoes, ready to pounce when fear peaks. Let me know if this setup makes sense, and then we'll move into real-world examples, from the dot-com crash to the COVID plunge, showing how these habits play out in crisis moments. Back in 1998, the internet was all anyone could talk about. Companies with little more than a URL were valued at hundreds of times their revenues, and the frenzy felt unstoppable. Buffett watched from the sidelines, and by the time March 2000 rolled around, the Nasdaq had collapsed by nearly 80%. While most investors were wiping out, Berkshire's cash reserve had swelled above 20%, and he moved into names with real cash flows, household brands that still rang up predictable profits. As dot-com stocks crumbled, he quietly picked up shares at a fraction of their intrinsic value. When the dust settled, while many were licking their wounds, Buffett was already compounding gains again. That episode wasn't a lucky break. It was the result of having a clear valuation process, insisting on a deep discount, and holding cash ready. Those habits turned panic into opportunity and set the stage for decades of compounding. If you had 20% of your portfolio in cash when everyone else was forced to sell, you could have swooped in and bought quality stocks at fire sale prices. That's exactly what Buffett did, and it made all the difference.